Welcome to the Daily Update. This is being prepared Tuesday, April 12th, where we'll look at the action in the market today and then see how things look for Wednesday, April 13th. And another down day. The downtrend still continues. Our technical picture continues to look weak. However, we could be getting to a short-term oversold condition. We could have said that after Monday's session, because some of our indicators were pretty extreme negative. Well, with the decline on Tuesday, we saw a lot more of our, at least our short-term indicators, start to give oversold readings. The day started, it was an interesting start to the day. We actually gapped higher right at the open, coming off the heels of the CPI report. And I'll go through that as I go through the video. And somehow a scenario developed that maybe inflation has topped out. Well, how in the world do they know that? Well, we're right in the middle of it. We're right in the middle of the story. We don't know how it ends. We don't know what could happen. Things haven't really changed all that much. So I think at first there was positive reaction to the report, which gave us a positive open. And then as the day went on, people are thinking, wait a minute, maybe things aren't as good as we thought they were. And the selling momentum that we've been seeing picked up and carried us pretty much into the close. So what can we say about Tuesday? We did have a gap higher open. In fact, we gapped above R1. And at the early part of the day, we were up 1.3%. And it's like, okay, here we go. Let's have a little bit of a nice bounce. Well, prices started to retrace, which is very common when we have a gap. So they fell back. There were probably people doing some initial short covering. And then once that got out of the way, prices started to retreat in an attempt to possibly fill the gap. But instead of stopping once the gap was filled, eventually, a little bit later in the day, we just kept on going. Selling eventually took prices negative and also down to below S1. We saw pretty uniform selling throughout the day, but a little bit of late day buying came in, and we ended up being down 0.34%, which is not a huge move. That's 1/3%. But if you look at how the day started and how the day ended, it was quite a bit more negative. But on a closing basis, this is pretty common for a sideways choppy market with a lot of indecisiveness. Volume was below average and declining. So we actually decreased in volume on Tuesday from where we were on Monday. The technicals right now continue to look pretty negative. I'll go through some inflation and interest rate charts to show you. And then, of course, the same geopolitical concerns that we've been dealing with here. So what can we say after Tuesday? The technicals are negative. The S&P closed below the 50-period simple moving average and the 200-day exponential moving average. And in our moving average tree, that's the last moving average. Now, there's other charts where I have other moving averages, but at least on a short to intermediate term basis, this is the longest term moving average that I talk about each day. We closed below that. The concern now, of course, is the same scenario that's been playing out where we see rising interest rates. And as interest rates go up, stocks go down. Well, we saw a retreat in interest rates. So that the relationship is still very high from interest rates going up and stocks going down. But we saw a little bit of a reprieve from that on Tuesday. One thing that is interesting, the VIX actually declined on a down day. Now that's just, it could be just a one-day wonder. What we'll be looking for is there are periods of time when the VIX goes up when the market goes up, and the VIX goes down when the market goes down. And that leads to an aberration that we sometimes look for, but not just after one day. We have to see, is this going to play out for a number of days? All of our yield curves are still, they're no longer inverted. And one thing, again, that could be adding to the negative backdrop is the dollar has been quite strong. And it actually closed above 100, the dollar index that I show the charts of. And another thing that I see as negative is As we're going down, sentiment is not really dropping. There's not a lot of fear in all the other things that we use together, and I have to cough, that shows that fear is not really increasing right now. That would suggest, at least on an emotional level, that we might have more room to fall. But on a short-term basis, we might see a bit of a bounce because we've fallen pretty far, pretty fast. The economic report that came out, this is one of the big ones. It was the CPI, Consumer Price Index, and it was high, but the initial positive reaction was it wasn't as bad as feared. And they work the numbers around and they manipulate them, and I'll go through the charts and to try to make it sound. In fact, you even had the administration front running the report, coming out even before the report was released, saying, well, this is all Putin's fault. Well, inflation's been in the system for a long time. You can't dump all the liquidity into the US economy that's been dumped in since the COVID pandemic and not have some ramifications from that. You've got these massive amounts of dollars into the system, and that's just, there's so many, they become less precious, so, or less valuable for each individual dollar. And because even though the dollar index is going up, we're seeing prices going up because we're in a very inflationary environment right now. But then, like I said, as the day went on, it's like they kind of rethought some things and said, well, this isn't all that good after all. The current market valuation is still saying that we are fairly valued, and that pretty much sticks for the week unless something really big happens. We are still in a trendless environment. The ADX is below 20 and declining, so look for more sideways choppy movement. Now, eventually we'll break out of that. We just are not really sure when or in what direction that will happen. The bias is negative because we had another down day, and for the last number of days, our momentum has also been negative. So let's go back through the day's session, looking at sentiment, and see this. We were at 46 yesterday, and we're at 46 today. And I even looked at the number. Did they even update this? Yes, they did. So there really wasn't a change in sentiment right now. And if we're seeing prices going lower and lower, we want to see that fear gauge bump over to the left. And we've been down here before at these price levels, and fear was really starting to climb. We're just not seeing that right now. We've been more in neutral territory for quite some time. Sure, it came down a little bit, but this whole 40 to 60 area, this is pretty much neutral. Then here's where the VIX actually declined on a closing basis. The bar looks like we spiked up a little bit. So it depends on how you look at this, but I was just gauging this on how it closed a little bit lower, even though we had a down day. And then the VIX of the VIX, it was a little bit higher, which shows that the VIX itself is becoming slightly more volatile, but we're starting to see a series of higher highs and higher lows with the VIX. So there is some fear coming into the market, and we're back above 20, but we're not seeing anything really extreme. We want to get up to these other really spiky levels before we see a lot of fear in the market, and it just hasn't come back in that much yet. Another thing we want to keep an eye on is this Ulcer Index. We continue to go higher as prices continue to go down, and then at some point, the hope is, if you're bullish, that this will top out, start to roll over, and we see some kind of a bounce with prices going up. Different sectors, kind of across the board, nothing really moved all that big. The weakest sector was financial, followed by healthcare and communications, which has been pretty weak. Tech was down, but not that bad. Some of the sectors that were up, energy was back up, utilities are up. These are the two stronger sectors that we've seen so far in 2022. And then this is what it looks like since the all-time high. Energy in the lead, followed by utilities. Staples are falling back a little bit. At the other end, we're seeing discretionary quite weak, tech and communication. And these kind of jockey for last place depending on how each day plays out. Looking just at the tech sector, we were down 0.44% and we are below the moving average. On the positive side, the moving average is still going higher, but if we stay below this moving average for a while, this line could start to roll over as well. Then also, I'm starting to show, at least on an as needed basis, the Sox Index. This is an industry group inside the tech sector, and the semiconductors play a huge role. And I use the Philadelphia Semiconductor Index. I know there's other ones available, but we're just coming off of a death cross and we were down 0.3%. Not a big move down, but still not looking very positive right now. As far as inflation, here's the big one. CPI came out. If you look at the red or yellow and you combine them together and you get orange, that's the official number that came out, over 8%. Okay. Now, if we go back to how it was calculated, according to 1990 methods, we would be well up into 11 or 12%. It's kind of hard to read a number here. So inflation would be a lot higher. Now, if we went back to how they did it in 1980, the last time they're saying, we haven't had this high inflation since 1980, 81, 82, 83. Well, if we did use the same calculation method, we would be up in the 16, 17% range, which is really, really high. And what a lot of people, and I've said this before, a lot of money managers, a lot of investors, a lot of the whole culture, generations have not seen this high inflation. They're young enough, so they didn't grow up in the 70s where we saw super high inflation and no growth. They're seeing this for the first time, and they don't really know how to handle this. And so you have a lot of people that think, oh yeah, it's just going to last a little while and things are going to go back to the way they were in 2021. Well, we're in a very different environment right now. And so that's what's causing a lot of the concerns in the market. Then looking at the CRB index, up 2.5%. So it was up pretty strong and is in quite a strong uptrend currently. Here's the CRB, which is outperforming the S&P 500 and looks to be breaking out. The inverse of this shows how the S&P 500 is breaking down when compared to commodities. Had some technical alerts and things started off pretty positive. Nasdaq went over 13.5, then up to 13.6, then went down to 13.4. So things really switched over negative. The euro set a 52-week low, which that could be considered good news if you're based in dollars. Then oil was able to get back above 95, then eventually 100. The dollar crossed above 100, set another 52-week high. So the dollar is seeing some real strength, which could be adding to some of the weakness of stocks because of the conversion rates, because of how the dynamics work. Companies generally like a weaker dollar. They don't want a terrible dollar. They just want a weaker dollar because that helps things look better. And that also helps the whole import-export process as well. Because, for example, let's say right now you wanted to go to Europe, if you even could do that these days, depending on how travel things go. Well, if the euro is coming down and the dollar is going up, that's a much more favorable exchange rate for you. Where a year ago, the euro was much higher and the dollar was much lower, so your dollar wouldn't go as far in Europe. So that's just kind of one way to look at that. Intraday, here we go. We gapped higher and it was looking pretty good right off the bat. The first half hour or so, we shot higher. Well, then what is very common, once this initial buying got done and we were above R1, we fell back and it's like, okay, are we going to try to fill this gap from the previous day? Well, we spiked up a little bit, came back down below R1, and then we danced along the unchanged level for a while. And then this is where the negativity really came in and took over. We ended up breaking more to the downside. Then we eventually went negative. So yeah, we filled the gap, but then we just kept going. And then we fell down here below S1. We didn't get to S2. There was a little late day buying that came in. So we closed off the low, but this to me anyway, it looks a little more negative than being down just 1/3%. We wanted to see some bounce come out of this, but our technical picture is showing us that what we saw on Tuesday is not necessarily a surprise. All right, here's the bar chart where we're down below the pivot. We still have a lot of resistance overhead that we're getting further away from now. So now we have to start looking at some of these other levels to see if they provide some kind of support if prices continue to fall. If we are going to get some kind of a short-term bounce from the oversold condition, we still have to watch some of these upward resistance areas. We're now down 8.32% from the all-time high, not into correction territory yet, the way I calculate things, but still, we had been down a lot less before we saw this recent decline. Then growth kind of went down a little bit, where value went up just a little bit. There wasn't a real big move from one to the other. Here's the growth chart, which shows that it's really been underperforming the value chart. And then here's the inverse, showing that value has been really outperforming growth recently. And then here's the Nasdaq 100. It declined a little bit compared to the rest of the S&P 500. So the big tech stocks underperformed, but not by very much. Just not a lot of conviction after that report came out. Here's the peer value index. It was down 0.1%, where the growth was down 0.49%. We take a ratio between the two, and it just shows how growth has really been having problems lately. Just the same scenario that we see played out. And so we look at this every day just to fill in the current chapter of where we're at. And then when things really start to switch, then we start a new chapter. Well, we're kind of seeing the same thing over and over right now. And then here's the growth against the value ETFs. And I'm still, see how the two highs, here's a high and then a lower high in the index, where here's a high and a higher high in the ETF. And again, I'm not quite sure what to make of that. Our trend, the ADX, although it's kind of flattening out, it still is below 20 and is below the moving average, so it's still declining overall. We have the red line on top and the green line on bottom, so our default trend then would be negative. We're not really getting much out of the Arun these days with kind of this choppy sideways market with prices where we've been before. We are seeing a decline in buying, but we're also seeing a declining in selling, and overall our oscillator just is moving sideways and has been for the last number of days. There was a change in the decision point scorecard where the PMO did cross over negative, and I'm showing that in the chart I have. So I'll go through that. Our breadth, we saw a decline based on price and volume, which is pretty much the same scenario we've been seeing. The advanced decline ratio is below 0 and declining. New highs, new lows continues to trend lower, both with our upper moving average and then our 10-day moving average. The accumulation distribution, we're getting back down to this moving average now. We're still above it, so that's slightly positive, but we are declining. If we end up dropping below this, that would be more negative. Short term, we are below the 20-period moving averages. Here's our moving average study, a decline in the 20, 50, and 200-day moving averages. Our spaghetti tree shows that we close below the 200-day exponential moving average. So now all of our moving averages are above where we're at currently. MACD, negative and declining. STO, negative and declining based on price and volume. McClellan oscillator, below 0, so it's negative and declining and not giving us an extreme reading currently. This is where we're starting to show some oversold conditions. The Stochh RSI, pegged, extreme negative. Williams %R, pegged, extremely negative. Force index, not really extreme, but is still showing a decline overall. And then going back 5 periods with our rate of change, We did bounce up a little bit as this recalculates, so that could be a little bit positive for right now after we had an extreme negative reading. Intermediate term, we are below the 50-period moving average. Just slice through both of these like they were nothing, and they're very important. We're well below the 100-day moving average, and you can see here where the S&P is below the pivot. Continues. Here's the PMO, negative. Negative based on price, negative based on volume. Then the PMO study shows a real decline in those PMOs that are rising, a decline in the buy signals, and flat to a decline in those that are even above zero. BPI saw a little more action after Tuesday's session, where it is in a decline after giving us an extreme positive reading, but has been going down pretty much overall since then. Here's the longer term view of that same chart. Moving average rainbow, we're starting to fall out underneath the rainbow currently. And if you look over here on the left, these are some of the longer term moving averages that I usually don't show on other charts. I'm trying to get more of an intermediate to long-term look at the trend using this indicator. That's why I bring it up every day. And even in the snapshot video, I usually bring this chart up as well. This is another thing that could suggest that we are short-term oversold. Short-term stochastics, really negative and bounced up a little bit. Intermediate term, extreme negative. We're still seeing a decline overall when we look at the full stochastics. The summation index going lower based on price, and we've been going lower based on volume. Our momentum oscillators, pretty much, if they haven't turned negative, they're just getting ready to go negative. So overall, this is a pretty negative picture right now. The CCI, also extreme negative, could be oversold, could suggest some kind of a bounce. Vortex saw a little bit of a decrease in buying or in selling pressure, but pretty much flat when it comes to buying power. But the red line's on top, so overall we are negative. Here's the RSI. We're declining with the traditional RSI based on 14 periods. We're below 50. The 9-period RSI is also declining and went a little bit down to flat on Tuesday. Different trading systems. The Elder system is negative with a red bar below the moving average, MACD declining. SPY, same thing, red bar below the moving average, MACD declining. SAR, also negative with the dots on top. Our different charts, Heiken Ashi, looking much more negative as it redraws and figures in the latest price movements. The KEGI is also negative. We're red and going lower. Renko also with a red box going lower. 3-line break also redrawing and looking more negative. Equivolume, we're seeing a lot of red candles these days. The ease of movement has dropped below zero, even though it was a little bit sideways on Tuesday. And then we have kind of a negative point and figure signal where it's calling this a high pole reversal, where these X's right here, it like that. And it looked like we could be breaking out. Well, that didn't happen. We're falling back. And so it might look like this is a spike. We drew in a couple of zeros earlier. Well, then on Tuesday, we added another zero and it's generating a signal now. So this would be more negative. Long term, we are below the 200-day moving average on both the arithmetic chart and the logarithmic chart. That's negative for the longer term as long as we stay below the moving average. Mega caps were down 0.39% and have really been having some trouble after trying to get back up to this moving average. The special case starting to roll over. This is a longer term oscillator that could be more negative with things. So things are switching. Doesn't mean that we're going to just race lower because we still have this potential positive backdrop, but we're kind of waiting to see if that's even going to kick in. Then our longer term moving averages were declining with the 50, declining with the 150, and declining with the 200. Then we've actually fallen through a Fibonacci retracement level here, 38.2. We dropped below that for the S&P. Broad market, here's the S&P, where mid caps have been kind of treading sideways more, and small caps have even been more sideways. But we really are seeing more price action in the big stocks right now. Dow Jones Composite down slightly, but below both of the moving averages. Here's the Dow Theory Chart, where we're seeing a decline in the Dow. We saw a lot of weakness in the transports, even though it bounced slightly on Tuesday, but we've been seeing a lot of strength in the utilities, and they were up slightly on Tuesday. FANG stocks down 0.67%, and just not seeing a lot of love right now, nor is ARK. It has it registered at that it was unchanged. That's kind of interesting. Usually this thing flies around all over the place, but still looking pretty negative overall. Dow, we're still right at the pivot, but we're below both the 200 and 50 period moving average. So it's holding up a little better. It was down 0.26%. Then the diamonds are negative and below the moving average and below the MACD. Small caps also could be finding some support down here at S1, but we're below both of the 50 and the 200-day moving average. Mid caps really not getting close to support until we get down to S1, and we are below both of the moving averages. Nasdaq, not really looking very good right now. This suggests that we potentially might have more room to fall. Doesn't mean that we're going to go there right away. We might wear off some of this short-term oversold condition and then get set to go lower. And then you might say we could be going back and testing some of these previous lows before we're getting set to go higher. That's one possible scenario, but I'm not really seeing that as a scenario until we get closer to these areas. Then Nasdaq 100 also looking kind of vulnerable right now. The Vixen, it did advance, but not all that much. That's just kind of interesting, where we saw a down day for the Nasdaq 100. The Vixen, it started off low and closed near the high because fear increased, but we are not seeing a higher high necessarily than what we saw the day before. And then the Qs are negative right now, below the moving average, and the MACD is declining. Here's the NYSE, also giving us some hope here. We might be finding some support around the 50-day moving average, and we might be finding support at the pivot right now. Broader index. The S&P 100 slightly outperformed the rest of the S&P 500. And then the Wilshire also giving us some hope. It's right at the pivot. So in broader terms, we're still seeing some potential support levels. Internationally, China, there's some interesting news coming out of China, but we're seeing the emerging markets in Europe, not so much emerging markets, but Europe is starting to roll over, and the US are starting to roll over as well. All stocks saw another down day, breaking below the 50-period moving average, down 0.55%. Here's the non-US stocks. They were down 0.57%. So they've been seeing some weakness lately as well. Other measures, here's the dollar breaking above 100. Haven't seen that in quite a while, since it was the beginning of the COVID plunge, when the last time the dollar was at this level. And then here's the weekly chart, also showing a pretty strong uptrend so far, and at least as after Tuesday is above 100. Oil got right back up to 100. Gold was up 1.43%, but are we going to see a breakout or another fake out? Here's the ETF. It was up 0.77%. You could make a case that we might be getting ready to go higher, and we have a golden cross back here that still is in play for right now. but this is just not trending all that well. It's just chopping around. Here's the longer term view of the gold ETF. Silver also had a good day, up 1.38% after a golden cross, but also chops around quite a bit like gold does. And here's a longer term view of that ETF. Bitcoin finally dropped below 40. And I looked right before we started recording, and it's kind of right around the 40 level right now. And I was looking at this chart, and again, you don't want to read too much into this, but here's one possible formation where here could be a left shoulder that we set back late summer into the fall. This could be a head, and are we setting up for a right shoulder here? If that is how it plays out, then we could see some real weakness in the future. Bonds. Okay, here we go. Here is our yield tree. I don't know, I'm not sure what to call this. All of these yields, if you make this chart a little bit bigger, they're all positive, with some of them continuing to advance. And then we're just seeing just this whole, my gosh, it looks like a roller coaster right here. Interest rates were down pretty good, but that really didn't give some support to stocks on Tuesday. And then internationally, we're just seeing a real climb in interest rates overall. Bond prices saw a little bit of a bounce on Tuesday. Corporate bonds were pretty much flat with the current yield at 3. It jumped up a little bit to 3.73%. Junk bonds, they were actually up a little bit. One of the days, usually when the market's down, junk bonds are down, but they were up 0.72%. And here's the latest yield that I could find at 6.45. Relative studies. Is gold breaking out again against the S&P? We've seen this before. Is it going to happen again and really lead to something this time? We don't know yet. Here's energy against the SPY. This is a definite breakout, and there's a lot of reasons why this might continue because of the inflationary environment that we're in. So it's showing a lot of relative strength. Here's energy against tech, which is also showing that energy is really outperforming tech right now. Growth against bonds. Neither one of them are doing very well these days. It's just which one is doing least bad right now. But growth is still outperforming the price of bonds currently because we're above the moving average, even though we declined over 1/3% on Tuesday. And then here's tech against the SPY, where this just shows how tech is underperforming the broader market. And then here's tech against the 10-year yield. Yields go down. Tech goes down because yields go up. But we saw a little bit of a bounce because interest rates fell on Tuesday. And then here's the correlation chart that I've been talking about. As we stay down here near the bottom, the closer we can get to 1. We never will get to 1. There's no such thing. It's kind of like a perfect 10, if you know what I'm talking about. There's never a perfect +1 or -1. We just get close to those levels. It just shows that as interest rates are going up, tech stocks are going down in a really strong inverse relationship from each other. Then here's the 10-year against tech. Just shows how interest rates have really been outperforming the tech sector. And then discretionary saw a little blip up compared to staples on Tuesday. And then here's the S&P, just showing how it's underperforming as interest rates continue to climb, even though it blipped up a little bit on Tuesday. Low volatility stocks down less than the rest of the market, down 0.12. And then this just shows how the low volatile stocks have been outperforming the more growth or higher volatile stocks. So what's our outlook for Wednesday? The technicals, they're negative. Pretty much see it across the board. That's when we get a little nervous. When everything seems to be pointing in pretty much the same direction, that's when you want to get a little bit defensive in your negative stance. Markets still remain in a trendless intermediate range because ADX is now still below 20. We have the battle continuing between growth and value. Interest rates are a concern. The supply chain issues. One thing that I heard is that, and I'm kind of hearing two different things, is that in China, apparently they're going to lessen some of the lockdowns, which might allow some of the folks there to go back to work. But then I'm also hearing that, especially in Shanghai, where the US Embassy, they're telling people to leave. And it has to do with the Omicron. Now, I don't know if there's more to the story than that, but we're seeing something that could be positive, but yet we're seeing some negative action on, between the US and China at the same time. So any one of those could end up having an impact on the supply chain issues that we've been dealing with. The PPI is the big report that comes out on Wednesday. We saw the consumer price index on Tuesday. Now we see the producer price index on Wednesday. Still things going on between Russia, Ukraine. Again, I look more for things that are impacting stock prices. And as terrible as that is, and as awful as things are that are happening, as far from a stock market perspective, we're not seeing a lot right now. Inflation and interest rates are the real big concern in the US markets these days. So what are our different scenarios for things to continue going down, which is what they've been doing, but we are still in a trendless environment. But the down scenario is if we see interest rates going up and the PPI report comes out with a really strong number, that could have a negative impact on prices, and our technicals are quite negative right now. Okay, what could make the market go up from here? We still have this positive backdrop after yield curves re-invert. They're all back to being more normal now. So at some point, will we see a bit of a thrust to the upside from that? Hasn't happened yet, but it doesn't mean it's going to happen right away. We are short-term oversold that I mentioned a number of times, and really our oscillators are not helping us out from a positive standpoint. So we have some moving averages either in the S&P or in other indexes, which may provide support, and the pivot levels may be providing some support. But the scenario that we're currently working with is that we are in a sideways market as long as the ADX is below 20 and continues to decline. Even though it turned up just a little bit, it hasn't crossed the moving average yet. And when we're in that environment, we see a real slowdown in price movement and really choppy conditions. And so for those of you that use a lot of different strategies, you may look at doing some market neutral type strategies, more credit spreads or iron condors or something like that. All right, so what's our conclusion? The S&P is negative, short-term negative, but likely oversold. Doesn't mean we can't go down further, but we're getting into a pretty oversold reading. Intermediate term, we are negative. All of our oscillators are negative or just about getting ready to cross if they haven't already. We're below the 50 simple moving average and below the 200 exponential moving average. So intermediate term is looking pretty negative right now. And then we're below the 200 simple moving average longer term. So that gives more of a negative picture to the long-term trend of things. Again, here are the daily videos that I make available. The one that I'm preparing right now is the full length update. Right after this, I will prepare a snapshot video. The weekends are when I do the weekly video. And then as I get a chance, I'll do the monthly videos. So thank you. Have a very good Wednesday, and I'll prepare the next video after Wednesday's session.